You're listening to the Maple Tree Capital podcast, where we put retail first, institutions second. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. You are listening to the Maple Tree Capital podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. What's in the treehouse? Maple Tree Capital has two portfolios, Heartwood and Jonagold, which are really centered around different investment principles. We're going to be taking a look at all of the moves we've made recently inside each of these portfolios, as well as their returns so far for the year. Retail possesses distinct advantages over Wall Street, particularly in terms of time and conviction. Jonagold, our growth fund, strategically leverages these attributes, focusing on companies with substantial growth prospects that are A, temporarily out of favor due to cyclical trends, B, significantly misunderstood, or C, a combination of both. Jonagold is designed to match and exceed the returns of the NASDAQ as well as the Russell 2000, aiming to return 35% a year. So this week was really not too eventful for our Jonagold fund, as the market sort of came out of digesting the Fed meeting and really has seen a large move to the upside following a lot of the tariff fears that we saw really in early April. So this week in Jonagold, we bought Oscar Health, ticker OSCR, a name that we had been watching for a while. Oscar uses AI to help deliver a superior experience in the land of health insurance. They've seen massive 40% plus revenue growth, an expanding member base to over 2 million, and improving profitability powered by scalable AI-driven tech and a full-stack platform that cuts costs while enhancing the user experience. Massive profitable growth is expected for Oscar this year. However, that is expected to stall next year as the federal government under the Trump administration looks to cut funding to the Affordable Care Act, or ACA, which is a large driver of Oscar's growth. This is a risk that we were willing to stomach, and really just days after our purchase, the Trump admin expressed language that suggested that the ACA and healthcare cuts may be pushed back out of the infamous One Big Beautiful Bill. This sent Oscar stock flying, up over 40% in just a week. We had just initiated our position in Oscar, and to see such large gains right out of the gate, that prompted us to actually sell our position last week and realize those gains immediately. So while we think that is a great company, and it's very similar to the likes of Upstart and Lemonade and how they're applying AI and technology to reinvent a very old legacy business, I think even the greatest would say a 40% return in a week means you've done a lot, correct? And so we believe it was warranted to sort of trim and sell out of that position entirely. Now, it's one we will reevaluate in the future, but we really don't like to chase momentum names, especially names that have a lot of pent-up interest at the current moment. Really, our strategy, and you heard a little bit about it earlier, is to position prior to that wave. And I think in this instance, we got a little bit lucky in when we positioned, and it seems like that wave of interest now is in full force. So further, in Jonagold this week, we sold heavily out the money, 0 DTE days to expiration calls on Upstart, our largest holding, which provided us with some nice covered call income that we will look to reinvest. I think this is a strategy that a lot of you listening can implement as well. Think about it this way. 1% of $1 million is a lot more than 1% of $100. All to say that the more money that you have, or for us, as our AUM, our assets under management, grow, well, the easier it is to make higher dollar amounts, not percentages, but dollar amounts of money, which then helps compound the portfolio very quickly. So as our position in Upstart has gotten extremely large, we've really been able to leverage that size to gain some covered call income that, in the grand scheme of things, may not be super significant, certainly as a percent, but it adds up over time, especially for us where, I, Henry Invest, am the sole contributor to the funds of Mapletree Capital. And, as in an internship right now, and still in college, depositing funds is a little more difficult than you may think. So really, really love that strategy that we've been doing with the covered calls there. And for a high beta stock like Upstart, which we have a very strong grasp on, lots of opportunities present themselves. So we do this with a bunch of our high conviction, high risk, high beta securities. We know that these are risky by nature just because of the beta, meaning how volatile is it relative to the general benchmark, in this case the S&P 500 or the NASDAQ. And almost all of our stocks have in the Jonagold portfolio have a beta over 2. So, we as such try to mitigate the risk of these holdings by implementing the various option strategies that we talked about earlier, including covered calls. And our ability to improve this, I think, will only improve as our AUM continues to rise. So today, our holdings in the Jonagold portfolio remain, in order from largest to smallest, Upstart, Lemonade, Grinder, and Hims. As of Friday's close, Jonagold has returned over 18% year-to-date, comfortably exceeding the S&P 500's return of 2% and the NASDAQ's return of 1%. This is an incredible turnaround for us, especially considering that near the end of Q1, when the tariffs really started to pick up, we were underperforming big time. And so for the full year, we are way back to outperformance. Moving on to Heartwood, our other portfolio. Heartwood is a high-conviction portfolio focused on misunderstood companies with the potential for operating leverage, brand reinventation, and long-term relevance. This fund seeks out businesses overlooked or underestimated by the broader market, often due to cyclical headwinds, unconventional strategies, or a lack of immediate profitability. Heartwood's goal is to compound at a 20% CAGR. This week, we reinvested our dividends from Electronic Arts, and we bought a new position, which you'll hear more about in our Stock of the Week segment coming up soon. But today, our holdings in Heartwood, from largest to smallest, really roughly remain the same. These include CrowdStrike, which we bought on the cyber outage fear, and that's really ballooned to be our largest position. Lyft, Uranium Energy Corporation, Academy Sports and Outdoors, Electronic Arts, Nevis Group, Reddit, and SharkNinja. As of Friday's close, Heartwood has returned a little under 3%, negative 3% year-to-date, that is, lagging the S&P's return of 2%, but really easing the significant downside that Heartwood saw in early April when our fund was down over 30% year-to-date. And so we've since retracted a lot of that underperformance, but it still is a work in progress. Underperformance has primarily been driven by our investment in Krispy Kreme, which we sold out of this quarter following lackluster developments in the McDonald's partnership. To conclude, Mapletree Capital remains committed to constantly and consistently improving our investment process. I'd like to close by sharing what I wrote in our Q1 2025 shareholder letter. We manage risk, but never pretend we can eliminate it. Risk is the canvas on which alpha is painted. As Pablo Picasso said, inspiration exists, but it has to find you working. In the same way, outsized returns don't come from waiting for perfect conditions. They come from doing the work, leaning into volatility, and putting conviction into motion long before the consensus arrives. When the crowd finally catches on, we'll already be miles ahead because conviction doesn't wait for consensus. You're listening to the Mapletree Capital Podcast. It is time for the Macro Pulse. What is going on in the market this week? Well, the Federal Reserve left interest rates unchanged this week, with the benchmark federal funds rate steady at 4.25% to 4.5%. The Summary of Economic Projections, SEP, included expectations of weaker growth, tariff-fueled inflation risks, and high levels of uncertainty, although Fed officials did note that uncertainty has come down. Still, the median Fed participant expects 2 25 basis point rate cuts by the end of the year. This cautious wait-and-see approach comes despite mounting pressure from the general public as well as the President of the United States. On Friday, 2 days after the recent FOMC meeting, President Trump shared in a Truth Social post his disdain for Powell, saying, quote, "We have virtually no inflation. Our economy is doing really well and will soon be doing, with the tremendous tariff income coming in and factories being built all over the country, better than it has ever done before. I don't know why the board doesn't override this total and complete moron. Maybe, just maybe, I'll have to change my mind about firing him," end quote. So we can see President Trump is clearly upset with Jerome Powell. And in some regard, I think he's right. You know, inflation is at the lowest level that it's been at in 4 years. And while, yes, tariffs do pose a potential inflationary shock to the upside, it does seem more appropriate for the Federal Reserve to sort of lower rates right now to sort of, I guess, cushion where the economy could be headed. And then if tariff inflation, which hasn't really been seen yet, does start to seep back in to the inflation reads, then raising rates again would be appropriate. But, the Fed says that they claim to be forward-looking, but in this instance, they're proactively looking ahead for tariffs. But really, in the past, with 2021 and the stimulus that came out, well, maybe they weren't as forward-looking. So there seems to be some sort of disconnect between what the Fed thinks is going to happen and how they're going to position for that. So it's something to monitor. But we did see also on Friday, Fed Waller said that the Federal Reserve could cut interest rates as early as July, a notably more dovish statement than what was said and seen by Chair Powell at Wednesday's FOMC meeting. Waller stated that the Fed has been on pause for 6 months, waiting for an inflation shock that has not survived. This gives him the confidence that the Fed may be able to lower rates as early as July. And that makes sense. It's exactly what we were just talking about. We waited sort of for this inflation data from the tariffs to sort of balloon. And it really hasn't been seen yet. And if you're Powell, you've got to ask yourself, with all the pressure mounting and criticism becoming more and more severe, how long will Powell stick to his guns and hold rates where they are when central banks around the world are cutting interest rates together? And the Fed seems to be sort of on an island. That's definitely something to monitor here in the coming months as we close out the end of the year. We'll see. Powell did say during his statement that you shouldn't put too much emphasis on the SCP just because it does bounce around a lot. And when it comes to where policy could be in 2 to 3 years from now, almost nobody has an accurate grasp on what can happen, given that the macro is so fluid and can change at a moment's notice. On Saturday, President Trump decided to bomb 3 Iranian nuclear facilities, pushing the United States into the Middle East conflict between Iran and Israel. This has heightened uncertainty, with many split opinions on the merit of the action. As a result of the attack, crypto prices are lower over the weekend, and Bitcoin has fallen below $100,000. Despite this, weekend Wall Street shows tech futures down only a measly 1%. We'll have to see how this shakes out when futures open up later tonight. That's it for today's Macro Pulse. This is the Maple Tree Capital Podcast. I'm your host, Henry Invests on X, founder of Maple Tree Capital. It's time for Stock of the Week, where we analyze a company that's on our radar. This Stock of the Week is a global product design and technology company based in Needham, Massachusetts, that develops, manufactures, and sells innovative small household appliances under 2 flagship brands, Shark, cleaning and beauty devices, and Ninja, kitchen and food prep appliances. Give you a second and see if you can guess what that company is. And yeah, that's right. It is SharkNinja. So SharkNinja, ticker SN, has seen shares rise over 100% since their IPO in 2023, driven by strong 27% year-over-year revenue growth, positive free cash flow, and strong profitability. SharkNinja currently trades at a 29 times trailing 12 months earnings multiple, TTM, and has a price-to-sales multiple of 2.3 times. This comes despite having a hefty profit margin of 7.8%. According to Zacks, analysts expect SharkNinja to post an EPS, earnings per share, of $4.99 this year and $5.73 next year. At a current share price of $90.80, that's a fiscal year 2025 PE of just over 18 times and a forward PE of 15.8x for a company expected to grow their top-line revenues by 13% this year and 11.5% next year. SharkNinja's stock has been under pressure lately due to President Trump's tariff threats. However, CEO Mark Baracus has shared that SharkNinja began shifting production out of China over 4 years ago in a response to the first Trump-era tariffs. By mid-2025, around 90% of U.S. goods for SharkNinja are sourced from Southeast Asia, and the company is exploring select U.S. manufacturing for simpler products post-2026. So this is a very, very interesting setup that we have going on here. SharkNinja has been on a tear from its IPO and really didn't stop that appreciation until the Trump tariffs started to come in and be a pretty negative sentiment on the overall stock. But what we've seen is SharkNinja CEO Mark Baracus has really gone on like almost a public tour of sorts, talking to a lot of CNBC journalists, a lot of journalists in general, and doing a lot of interviews to sort of share that the tariff risk for SharkNinja is maybe not as extreme as the market is thinking. And so I think that portion of the thesis is very, very interesting. Now, there are still tariffs on Southeast Asia, and there are tariffs on Vietnam, which is where a lot of their production comes from as well. So we'll have to see how that pans out over time. But in general, too, I think of SharkNinja, you think the margin there of 7.8% for appliances in a very manufacturer-heavy business is pretty good. So I think, at Maple Street Capital, we view the tariff risk here as more negligible than maybe Wall Street does. We think SharkNinja is set up well to navigate the challenges that Wall Street really has put on for them. Their diverse product offerings of cookware, cleaning supplies, and even now an expansion into beauty make SharkNinja an attractive business at an attractive price. Its products resonate with Gen Z and younger consumers. And really want to hone in on this for a second here. Recently saw, too, a hedge fund manager pitch Best Buy as a lawn because of the simplicity of the product, the cheap valuation, and the fact that Gen Z is going to want a lot of help with installation and easy accessible tech devices. So whether or not you believe that view of Gen Z is true doesn't detract from the fact that that's what a lot of people are currently believing, that my generation, Gen Z, is going to want simpler, value-oriented products that are very easy and not complicated. But that's exactly what SharkNinja has here, and I think that is the moat behind what they're doing. Apart from any patents or things like that, if you think of a SharkNinja product, right, I don't even know if they have patents for a long enough time. A competitor can buy it, reverse engineer the product, and then push out some competition. When you're looking at SharkNinja, you're looking at the brand trust, the history of quality, the history of durability. This company's been around for a very long time, and so consumers who have bought products with a Shark or a Ninja, the products have lasted, so that makes them more likely to go out and buy another product. And then you come from the value standpoint of SharkNinja products offer great quality, they're very good at what they do, and it's for a reasonable price. And that's the exact kind of product that the consumer is looking for in today's post-inflation shock economy. And with new spending habits and a new value perception habits for consumers, we think that products and companies that provide products like this are going to do well in the future. So Gen Z likes the easy setup, the durability, the on-trend design, the value proposition, and the overall convenience that SharkNinja provides. And the last thing that I'll say on that, too, is if you actually go on TikTok, you'll see a lot of consumers buy the SharkNinja products and then do marketing for SharkNinja. Challenges. Oh, I just got this device. Look what it does. And so this is a very strong proposition for the marketing aspect of SharkNinja, where they don't even have to market their product solely by themselves. Others will market it for them, and that is a sign of great innovation. That is a sign of a great product and a great price. So SharkNinja is today's stock of the week. Please note that all opinions shared today are that only of Maple Tree Capital and no other party. Please do proper due diligence and seek proper financial counsel before making an investment decision. Nothing presented today is investment advice. This is the Maple Tree Capital Podcast. It is time to answer your questions in the Retail Mailbox segment of this week's episode. So if you'd like to ask a question for future episodes, keep an eye out on my X account at Henry Invests and the Maple Tree Capital X account at Maple Tree Cap to see when I sort of ask you for the questions to be featured in this week's or next week's episode. So today's only question comes from Cade. Cade, thank you for being a longtime follower, who asks, what is the top thing you look for when starting a new company investment? I know you do a ton of pre-screening. Yeah, so this is really a great question, and it goes back, I think it's a lot deeper than what most people think. So traditionally speaking, when you look at a company, you're going to look at their financial picture. You're going to want to look at, okay, where's profitability trending? How's the top line growing, right? Is revenue increasing? How's their cost structure? Free cash flow positive, right? Those are all the traditional metrics that you would look at. My approach and the approach at Mapletree Capital is sort of a little bit different than that. Yes, valuation is very important, but it's not necessarily, in our view, the most important thing when determining an investment, especially if you're going to do misunderstood investing. We try and find companies that the price has been very euphoric in the swings, to the upside, to the downside. In other words, high beta. And then we try and analyze the story of those companies. Why did the valuation get so exuberant? What caused it to get so pessimistic? And I think in our view, when we look at a lot of stories like that, what we'll find is a disconnect between narrative and price. Meaning, for example, on a company like Lemonade, when the share price was at $180 in 2021, and now it's at $50 or so today, well, you would think that during that time frame, the performance of the business has gotten a lot worse. But actually what happened is the performance of the business, they've like 10x the business in terms of in-force premium, right? The business itself has gotten so much better. The only thing that's changed is the valuation of the business was compressed because it was way overvalued in 2021. And so we think at Mapletree Capital that the best way to start a pre-screening process is to find companies that are consistently executing over time or have turned around their execution, but have not yet returned to the valuation that they were at however many years ago for whatever reason that was. In other words, we look for companies, younger companies, where the performance of the business has improved, but sentiment and hype around the company has really come down substantially. And we found a lot of opportunities there, right? Lemonade is one, Hims and Hers is one, Upstart is another one, Grindr is another one. CrowdStrike is another one. These are all examples of companies that have traded at many different valuations throughout their lifetime as a public company, and those valuations may be compressed for several different reasons. For Upstart, it's because of severe macro headwinds that sort of caused the business to go upside down. But if you started to follow the story or pay attention, sort of post 2022, there were small signs, not in the financials, but in the conference calls, in the interviews with leadership, that they were taking the right steps to plug the holes in their business. Very similar story for Lemonade. For CrowdStrike too, right? You had the big cyber outage. Everybody started to worry that CrowdStrike was going to lose their market-leading position. But if you took a step back, you listened, and you realized the story of CrowdStrike, you'd understand that it's a very sticky business model. And while, yes, a colossal mistake, certainly nothing that would cause the company to go under. So CrowdStrike traded at a very high valuation. It's always been a high flyer. And then that incident right there caused valuation compression on a very high quality name that sort of had a big bruise on their shoulder. So we like to look for stories that have bruises, stories where there's a disconnect between narrative and price, and we try and position before that story starts to become more clear to the market, either because the market is now starting to discover what that story was, or because the story is starting to actually play out and show up in the financials. And so that's sort of what we look for from a storytelling point of view. Now, the other thing that we look for is very high trust in management. And that's not to say that management hasn't made mistakes before, right? Or they've done something that hasn't been good for the business. But normally we try and look for management teams that are aligned with shareholders in the sense that for Upstart, right? They've made several mistakes in 2022, but during that time frame, they kept their core position. So that's something that we really look for. And those are sort of the framework as to how we think about what companies that we want to maybe invest in our pre-screening process. And then, of course, on the back end, too, we're going to do valuation work, price to earnings if they're profitable. price to sales, price to free cash flow, and we try and look for inflection points in the financials as well. So as important as it is for a company to be trading at a good valuation, right, a reasonable valuation, if a company is going through a bunch of inflection points and their fundamentals are improving, well, it's definitely warranted to pay a higher price for that business. So we try not to hone in too much on letting a valuation that may seem a little expensive stop us from buying a company that we think is really headed in the right direction. So hopefully that helps to explain why we put more emphasis on the story, the narrative, the team, the history of companies, and the mission that they're trying to accomplish than whatever valuation they're trading at any peak and trough of the valuation cycle that is high beta growth. We try and get in on very good companies that have low valuation multiples relative to their historical standards because the business itself has experienced a re-rating due to sluggish growth or some other sort of flip in the fundamentals. And you can find examples of this everywhere, and I'm sure there's some in the market right now. We talked a little bit about earlier in this episode what we did with Oscar Health, which was one that we identified as having a disconnect between the performance of the business and the valuation of the business relative to where it was in the past. The company has only continued to execute while the share price has fallen. So while yes, that means it was overvalued, certainly in 2021 and maybe even in preceding rounds, the business is continuing to show proof of concept and the valuation was getting cheaper. That was an opportunity that we thought was asymmetrical, and we don't necessarily find them too often, maybe as obvious as Oscar was. And I think the lesson from that one that we learned is the re-rating was in about a week. And so we were very fortunate to catch the wave, but it doesn't always happen that fast. We've been sitting around for the Upstart re-rating for a couple of years now, and we think it's on the way, but, hasn't happened just yet. Same thing with Lemonade, starting to go and really experience the re-rating that we want, but we haven't seen it in full force. So patience is the other thing that we look for on an investment, meaning if we buy this company, are we willing to sit? Do we have confidence in its ability to survive and sit on it before that re-rating process begins? And, some of the companies that we buy never re-rate. Some of them never turn it around. Krispy Kreme has been a huge loss for us, but that's really part of the strategy. And we're working to get better at identifying when those companies that we're waiting on really aren't turning the corner. And so the worst part of our performance has been holding on to losers a little bit too long. But the good part about what we do is we really hold on to a lot of our winners just because we develop a lot of strong conviction in them through that waiting process. But hopefully that's helpful in explaining a little bit of our framework and how we think about investments, where we look for opportunities, and we also constantly validate the companies that we own, and we just have to get a little bit better at identifying when a company has maybe had a little bit too much time to sort of turn the business around, and I think that'll help our performance as well. But thank you for the question, and thank you everybody for tuning in to the Retail Mailbox segment of today's episode. You've just listened to the Maple Tree Capital podcast hosted by me, Henry Invests on X. If you enjoyed this week's episode, please leave a like, please give us a rating here on Spotify, and send any feedback that you may have to me on X at Henry Invest. Thank you everybody for listening, and I will see you next week.